The US credit rating just got downgraded, which has only happened 2 other times in US history. Once in 2011, the other in 2023, and both times the S&P fell 10%. Now, more than likely, we're going to see a correction in the stock market considering it's been on fire, up 23% in less than 2 months. The credit downgrade is a warning to the market, to the economy, and to policymakers. If the debt burden continues to outpace GDP, interest payments servicing the debt will exceed defense and Medicare. You're looking at $1 trillion annually just to pay the interest. The interest payments are serviced from GDP, which would crush US growth. On the other hand, the warning to the investors is the US is at higher risk of defaulting on those payments. And that causes US creditors, bondholders to dump their US treasuries until something is done at the Fed or in Congress. And if there's more sellers than buyers of US debt, interest rates rise. Now, one of the key issues the bond market has with Trump, he talks about the biggest tax cuts in history, but that all comes from borrowing debt. He needs more buyers of US treasuries in order to convert that into fiscal stimulus. He needs the Fed to lower rates or come in and start buying treasuries. Back in 2023, we saw interest rates move from 4% to 5% within a couple of months, and the Fed stopped hiking rates. Now, because this has to do with US debt in the bond market, the key indicator to watch is the MOVE index, bond volatility. Once you get around 140, policymakers always step in. If panic follows this downgrade and interest rates spike, expect policymakers to step in. Keep your eye on the MOVE index. The peak in the MOVE index is the bottom for markets. If you want to learn more, go to the website in the bio, weekly newsletters, and educational courses. Stay blessed. See you on the next video.